You're welcome back to my channel. This is regulatory platform where we discuss insurance regulation and supervision. We review global practices and we also bring local perspectives. If you are joining us for the first time, my name is Dr. Sam Onyeka. I'd like to welcome you to my channel. And I request you to kindly subscribe to this channel. And if you are subscribing for the first time, remember to turn on your notification bell. This will enable you to obtain notification each time we upload new videos. Once again, thank you and welcome to my channel. During the last episode, we discussed solvency regulation and we identified the various considerations that are involved in making laws and regulations relating to solvency. I hope that you got that video, but if you missed it, the link is already supplied at the description box. On this episode, we are discussing premium regulation. And immediately, I would like to let you know that there is a relationship, strong one at that, between solvency regulation and premium regulation. Because where there is poor premium regulation, then it will affect solvency of the insurer. Okay, this is the way I'm going to go. I'm going to explain briefly the meaning of insurance premium and how insurance premium is arrived at. I will look at the objective of premium regulation. I will discuss existing practices on premium regulation, and I will end by looking at Nigerian perspective. I hope we'll be able to cover all this within the short time allotted to this video. Right, now what is premium? Premium is simply the price for obtaining insurance protection. Technically speaking, it is consideration in insurance contract. Every contract must have consideration, and the consideration for insurance contract is the premium. In Nigeria, right now, we have a policy on no premium, no cover. So a policy of insurance is not enforced except until the premium has been paid. This may not be the practice globally, but because of Nigerian peculiar circumstances, that is how it is. All right, so how do we arrive at premium? How do we compute premium, and what influences premium computation? First, premium is arrived at by applying a rate. The insurer applies a rate to the exposures he has accepted. This is a little technical, but what it means is that the work of the insurer is to underwrite, and that means to decide whether to accept a particular risk or not, and when he accepts, at what rate. So the rate is the premium. Now, the premium has three components, if you like. The first one is the risk premium. The risk premium is the actual amount that the insurer will be called upon to pay in the event of loss. When there is a loss, as a matter of fact, the loss is not always total. For example, if a building is destroyed, if you go to that building, if you had a very strong foundation, you see some structures standing. And so it is not possible for a structure to be destroyed 100%. And so we talk about maximum probability of loss. And therefore, when you are applying a rate, you are now looking at what exactly you are going to be paying in the event of loss. So it may be, for example, a building that is 70 million. After loss, you may discover that the actual amount you are going to be called upon to pay in settlement is 40 million naira. So the risk premium here, like I said, is the actual amount the insurer will be called upon to pay in the event of loss of the subject matter of insurance. Now, to this risk premium is added some administrative charge and a margin of profit, so you get the actual amount of premium. All right, having explained that, let us look at the objective of insurance premium regulation. Why do we regulate insurance premium? Now, the primary objective of regulating insurance premium is to ensure that the insurer accumulates sufficient premium or fund to be able to settle claim. When the rate of premium is too low, then it means that the insurer will have less than sufficient capacity to settle claim, and that brings about the issue of solvency. Remember that solvency means the ability of the insurer to settle claims that are presented to it. So when the insurer is unable to settle the claims that are presented to it, there is insolvency. And one of the easiest causes of insolvency is charging low premium that is lower than necessary. All right. On the other extreme, charging premium that is unusually high or excessive will drive away certain products from the market. Such products will become unaffordable by the insuring public. And so the objective of premium regulation is to ensure that the premium charged by the insurer is neither too high nor too low, as the case may be. I hope you understood that explanation. All right, so let's look at some of the current approaches to fixing insurance premium. Now, I will divide the insurance market for this purpose into two. One is tariff market, and the second one is non-tariff market. Now, in tariff market, we are looking at those jurisdictions where the price of insurance is fixed by law or by the state, as the case may be. A typical example of tariff jurisdiction is United States of America. In the US, regulation is by state bodies, state insurance bodies. And at the same time, we have bureaus whose responsibility is to fix insurance rates. And the insurance market respect these rules that are made relating to fixing insurance rates. All right. On the other hand, we have non-tariff jurisdictions. Non-tariff jurisdictions are those jurisdictions where insurance rates are actually fixed not by the regulator or by law, but by insurers themselves. So there is relative autonomy, if you like. So the insurers themselves decide how and what amount they are going to charge for every risk that is presented to them. The responsibility of the regulator in such jurisdiction is to monitor implementation of these rates that have been fixed by the insurer to ensure consistency and uniformity, if you like. Now, I need to let you know there is at least one exception, even in the non-tariff jurisdictions, and this is with respect to compulsory insurances. Now, compulsory insurances are those insurances that are made compulsory by law. A typical example of compulsory insurance is motor vehicle third-party insurance policy. In fact, in almost all jurisdictions, you can't drive a vehicle on the road unless you have a policy on motor vehicle third-party insurance. So this is the way it works. And in such jurisdictions, the regulator is saddled with responsibility of fixing rates for compulsory insurances. So even though the rates are fixed by insurers, but with respect to compulsory insurances, it's still the responsibility of the state to ensure effectiveness in relation to compulsory insurances. All right, so let's look at what happens in Nigeria. Nigeria, like I said, is an example of non-tariff jurisdiction alongside with the UK. Now, in Nigeria, the insurance companies actually fix the rates for insurance products, particularly with respect to non-compulsory products. Now, what the regulator does is to monitor implementation of these rates that have been fixed by the insurer to ensure uniformity in the market. Now, with respect to compulsory insurances, the regulator in Nigeria, the National Insurance Commission, has the responsibility to fix rates. And by the extant legal framework, particularly Section 53, the industry or the insurers are not allowed, whether individually or by way of association of insurers, the Nigerian Insurance Association, cannot increase the rates of compulsory insurance without reference to the commission. That is the state of the law. Now, the only comment I have here is that we need to see more proactivity on the side of the regulator in terms of ensuring that what insurers file as rates are actually being implemented as such. And on this note, I want to thank you for finding time to be with us on this episode. Remember that insurance premium is the price of insurance, and that the essence of Premium regulation is to ensure adequacy in terms of premium that the insurer is charging and to avoid unnecessary high premium that can discourage insurance products from the market. Thank you so much. My name is Dr. Sam Onyeka. Looking forward to seeing you next time as we come on board. Thank you.